Hey guys, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and best-selling author of Australian Real Estate Investing Made Simple. Welcome to today's video, and I'm going to give you a really good update on what's happening in the property market. There's been a lot of turmoil happening right now in the property market. You would have seen the news, a number of fronts, and I'm going to do another YouTube video just purely on the perfect storm that has been created, especially in Melbourne and Sydney in the property market. And it's a combination of a lot of developers and builders going bust and taking a lot of businesses down with them. And also we have an extreme rental crisis in Melbourne and Sydney where people are literally priced out of the market, and legitimate families that are working full-time in white-collar jobs are forced to live out of their cars and caravan parks, which we've never seen before. In the 25 years that I've been investing in real estate in Melbourne, I have never seen this extreme version of what is happening in the rental market. Bad news for tenants, great news for landlords, because I can tell you I'm increasing my rents on my properties astronomically high, and it's purely based on the advice from my property managers. So despite the 10 increases in interest rates, my properties are cash flow positive, and a lot of properties that are settled recently have become cash flow positive because the rental increases have been astronomically high, as we're about to see. So welcome to today's update. Bit of a personal disclaimer, there's no guarantees in life, but the guarantees, if you do nothing, you're going to end up dead broke renting for the rest of your life. That's guaranteed. Why should you listen to me? I won't bore you with my credentials. I've got a lot of letters after my name. I'm a real estate agent. I've got a diploma of financial planning, mortgage broking, and real estate. The biggest thing is, guys, that I'm a property investor investing in Melbourne right now. I'm out there doing it. I'm not just a theorist or an academic. I'm actually doing it, buying properties, refinancing. I'm going through the same challenges that a lot of you viewers are going through right now. And I'm refinancing a lot of my properties. A lot of my properties are coming out of fixed rates and then going into variable rates. And I'm going from 2.93 into 6% and 6.5. So it's very interesting. Despite all that, a lot of those properties are still cash flow positive because the areas and suburbs that I've invested in are blue chip capital growth suburbs, which means that people have a lot of disposable income and rents have gone up astronomically high in those suburbs. So choosing the right suburb, guys, is everything. If you choose the wrong suburb, you're going to have a very challenging time building your property portfolio. Once again, a bit of shameless promotion here on my two books. So if you want to get a copy of my first book on finance, check it out any good bookshop, Amazon, or just go to my website, bookonfinance.com.au. And my real estate investing book as well, realestateinvestingmadesimple.com.au. And also, I really want to thank you guys for supporting my books because my books have gone #1 bestseller multiple times on Amazon. You can see there, my real estate book in this example has gone #1, and my finance book is #8. I've had #1 and 2 spots many times on Amazon. So thank you for buying my books. Thank you for supporting me. And I'm halfway through my third book as well on property due diligence and research, which will come out probably next year at some stage. I do procrastinate. I'm a perfectionist and I'm a procrastinator at the same time, which is why it takes 5 years to write all these books. Where I could really smash it out in 3 or 4 months if I was in a mountain cabin somewhere, which I'm not. And also, I've been really busy looking after my clients and building their property portfolios. I've got clients that are buying their 7th, 8th, 9th, 10th property, which is very exciting for them. The property selection methodology we've been using has worked perfectly. And I'll show you some examples. Even though the last 3 years in COVID-19 scenarios, my suburbs that I've chosen have outperformed the entire market. So I'm going to show you some suburbs that you should be investing in and suburbs you should stay away from investing, stay away from like a Tina Arena concert. So let's talk about the actual market and what's happening in Melbourne and in Australia. The first thing you got to understand is it's time in the market, not timing of the market. So it doesn't really make a difference where we are in the market. It's completely irrelevant, okay, first of all. The only number you should be aware of is that the property market in Australia is worth 9.3 trillion, and we only have 2.2 trillion outstanding mortgage debt, which is 24%. So imagine you have a house which is worth $1 million and you've only got $240,000 mortgage on that house. Are you stressed? Of course not. So all these doom and gloom, all these kind of, as we call it, fake media Armageddon predictions have failed to materialize because we were supposed to have how many bloodbaths now? I mean, every year there's a bloodbath. Every year there's going to be a market correction and nothing's happened. I'll show you the stats. And if you watch my other YouTube videos, you know that I've got stats going back to 1890 on the Melbourne property market. The reality is, guys, the mortgage ratio, the gearing in real estate is very low in Australia, and the most important thing to understand that this 2.2 trillion in mortgages is concentrated disproportionately in the cheapest suburbs on the fringes of the major capital cities, in new house and land estates. The best suburbs in Melbourne and Sydney and Brisbane have very low mortgages, and most properties are paid off completely. And this is why people choose not to sell, and they choose to sell at the peak of the market, if they choose to sell at all, rather than selling at the bottom of the market. And this is why there isn't going to be a major correction in the property market in Australia, in my opinion, in the next 10 or 15 years, assuming everything goes as it goes. And look, the Labor government is perfectly stuffing up the market and making it even more, putting more pressure on volume of stock. Just so you know, every time we had a Labor government in power in Australia, at the same time, we had a property boom. Labor is synonymous in fucking up the economy to the level where, where what actually happens is rentals go up, volume of stock is restricted, and then landlords capitalise on the opportunity, which is ironic because Labor should be representing people that work in labour. So by doing what they're doing, they always stuff it up. Things like first home buyers grant always backfire. They actually create more pressure on property prices. Any kind of discount incentive, any kind of discount on stamp duty always has the reverse effect that it's intended to have on the property market. So whenever there's a Labor government, we know there's going to be a property boom. And the best example of that is they're going to let 650,000 people into the country in the next 2 years. Most of them will be going to Melbourne and Sydney, 57% in fact, of skilled labour. And we're at the moment having a shortage of 100,000 homes per year. What do you think is going to happen to property prices? You don't need to be a genius mathematician to work it out. There's going to be a massive shortage of houses, and the ones that are in the market are going to go through the roof again. Nothing new, guys. Same old story playing out over and over. But anyway, let's have a look at the micro level research on what's happening in the market. Last 3 months, if we look at the Australian national market, which I don't really know why you would group all the major capital cities and regional towns together and derive some kind of a mathematical sense out of it. But this is what everyone's obsessed with, so let's talk about it. 3 months average, negative 2.3% for the quarter. 12 months, 7.9%. So we definitely are still going down as in terms of major capital cities. The 3 month changes, if you look at the average. Now the bottom of the market, by the way, as you can see there, was last year around November, and I picked it perfectly, and I told people, actually, if you're on my database, I sent you an email saying we've just hit the bottom of the market, what are you going to do about it? Just literally 2 lines, and I showed you a graph. And what happened was I predicted accurately we're going to have a W equation where we're going to go sideways a little bit and then go up again. The best opportunities were to buy last year in the market. If you've missed last year as a buying opportunity, just in creating a new product, because ultimately there's a lot of drivers of capital growth, but the biggest driver is construction, the cost of constructing a dwelling. So when you buy a house, you have the land component, you got a dwelling component. Just so you know, the cost of building a 15 square townhouse, let's say 160 square metres, 3-bedroom townhouse, has gone up $95,000 in the last 12 months, just to build the same product 12 months ago, because of inflation and because of, especially steel and timber. So just to create the same product for a developer is 100 grand more now, today, than it was 12 months ago. So what do you think they're going to do? Do you think they're going to become a charity and build something at a loss, or do you think they're going to add $100,000 to everything they're selling? Of course they're going to add $100,000 to everything they're selling because they've got to make a profit margin. So properties that I was sourcing last year in Heidelberg Heights and West, 2-bedroom townhouses that were selling for $695 are selling for $795. Not because there's capital growth in Heidelberg Heights or West, it's just that it's more expensive today to build the same product as it was 12 months ago. So the best time to buy, which is really where the money, smart money goes in, is at the bottom of the market when there's doom and gloom. When the market recovers, you've missed the opportunity to buy if you're trying to time the market. Now, the most successful investors do not try to time the market. They just invest any time they can because it is very difficult at any time to buy a property, to get finance. And also, your life, things could be happening. When people ask me when's the best time to buy property, it's like saying when's the best time to go to the gym, right? Today. Tomorrow is the second best time. The quicker you get to the gym, the quicker you're going to achieve your goals, whatever it is, whether it's bulking up or getting fitter or losing body fat. There is no timing of going to the gym. There's just time in the gym, okay? You just go whenever you can go, every day. It's the same thing with property. You buy whenever you can buy, and then over time, guess what happens? All your properties just go up in value, and that's it. There's no magic bullet to these guys. People think there's a secret clock somewhere, tells people when to buy at the bottom. Yeah, it's nice to get a discount at the bottom, absolutely. No question about it. In February 2019, if you remember, I was releasing projects in Essendon where the developer was giving between 5 and 10% cash rebate on settlement. So for $1 million property, you put a $100,000 deposit, you get the deposit back at settlement. Now those opportunities are gone and they'll never happen again unless we have a massive correction. So yeah, it's nice to get that property at a discount of 10%, absolutely. But long term, is there going to have any impact on your portfolio? No, it's going to have no impact at all. You just got lucky at one part of the cycle. And luck will not make you wealthy, guys. It's consistent performance over a period of time that's going to give you results. Don't try to look for shortcuts. That's a very poor person's psychology. It's a long-term game. That's how you build the body. That's why when I started powerlifting 25 years ago, and I was 72 kilos, 6'2", and now I'm 140 kilos, and I deadlift over 300 kilos. It took me 25 years to deadlift 300 kilos, guys. It didn't happen because I went to the gym one day where it was perfectly 23 degrees outside and I felt really high on energy. I just went all the time. And same with my property portfolio. I've just invested whenever I had the equity and the serviceability to invest. And you stick to the fundamental suburbs. That's what you don't deviate from. So 12-month average, you can see there, if you look at the major capital cities, for Australia, we have, in terms of median price, 7.9% negative. Regional towns, 4.2% negative, and combined capitals, negative 9.1%. In terms of the major capital cities, you can see the trend has already gone up. So especially like if you look at Melbourne, for example, Melbourne had the lowest point last year. And the same in Sydney, really that's 75% of the property market. So those two major markets really determine the rest of the market. Having said that, pardon me, you can make money anywhere. You don't need to be in Melbourne and Sydney to make a killing. I know investors in regional towns like Shepparton, Bendigo, Ballarat that are making an absolute killing. So the only risk in investing, guys, there is no market risk. The only risk is you and your knowledge. That's it. Your lack of knowledge creates uncertainty and doubt. If you cultivate your knowledge to a high level, you're going to be skillful, you're going to make money. That's all it is, just timing the market. So you don't need to be in Melbourne and Sydney to make these. Is it easier? Yes, it is, because we know where the good suburbs are in Melbourne and Sydney. But I'm just saying that I know a lot of successful property investors that are focused on regional towns, they have specialised local knowledge and they're making a killing. And then later on you can diversify. Once you make a killing in the regional town, you can go to the big smoke. But definitely we hit the bottom of the market here. We are showing a recovery. It's still negative, but we are recovering in terms of the property cycles. No question about it. And this is the same for Perth. It's going sideways, Hobart, and then Darwin, ACT. So you can see there, we had the peak of the market. We hit the bottom last year. Now we're going back up. Same old story repeating itself, guys. Nothing new here to see. The top end of the market is going hard. So for example, in Melbourne, if you look at this is a percentile based on price. So you have 25 percentile, 50th percentile, 75th percentile in terms of price structuring. So 75th means these are the most expensive properties. This is the middle market. These are the cheapest properties. So in terms of the top of the market has started to move slowly in Melbourne and Sydney again. People are back buying mansions and they're fighting over key properties. It's just the beginning of the transition though. It's just early days, but I'm talking to a lot of agents in Melbourne where last year was dead quiet. They're seeing for the first time, especially in March, that the top end is starting to come back in. Now, just so you know, every property cycle is started by the top end. It's always the most expensive properties that go first because that's where the smart money is. That's why people have $10 million to spend on a Brighton house, not because they're lucky, because they're smart. So that's why it's called the smart money. Smart money goes in first, and then the mid-market goes in, and then the poorest market, which is the cheapest properties, go last because they're social proof and they see that everything is recovered and it's safe to go in, and they go at the very end. I didn't design it this way, by the way, so people get offended sometimes when I talk about things. Guys, I'm not a market maker, I'm just an observer. I'm an impartial observer. In terms of property cycles, you can see there, it's very cyclical. This is the 28-day rolling average for properties. So once again, all you've got to understand as an investor is that the property market is cyclical. There's an emotional high and a reactive low, and we've hit the low and then we're bouncing back from the lowest point in the market going up. The thing about it is there isn't really good stock on the market at the moment. A lot of developers have shelved projects. There's a lot of uncertainty about inflation still going around mid-sixes. So developers are finding it very difficult to fix contracts and commit to property prices 12 months out because they don't know what the actual cost of construction will be. There's a critical labour shortage as well of skilled labour. A lot of labour from Melbourne has left and gone to Brisbane. But beyond that, it's a challenging market for developers to work out of. So the best developers that I know are actually not developing anything at the moment. Now, they're super wealthy. A lot of them live in Brighton or Toorak. A lot of them are liquid, 10, 15, $20 million. They're not depressed, guys. They're super happy. Even when they are depressed, they were depressed in the Rolls Royce or Ferrari. So they're still depressed in wealth, okay? And look, I've had lunches with them and they told me, Konrad, we're not going to build anything in 12 months because we don't know what to charge people. We don't want to overcharge because overcharging, well, people say, well, why can't they just overcharge? Well, if you overcharge and you sell 10 townhouses and you sell them, let's say they're $1 million today, you sell them for 1.2, what if the valuations come in at 1.1 and no one can settle those properties? See, that's a problem in itself as well. So you've got to be able to price the product accurately to make an acceptable margin so you can get construction finance from the bank, but also you've got to allow the people to actually settle. So you've got to have valuers and the banks in, because if you don't settle, you're back to square one. You're back with 10 townhouses that no one has purchased and you've got to resell them and engage agents. Because of this uncertainty, the best developers that I'm working with are not building anything at the moment. Combine that with the average person out there that's got an established house, the volume of stock that's listed right now is 30 to 40% lower, and I'll show you which suburbs, compared to the same time last year and the previous year. So we have a critical shortage of stock at the moment on the market. People are not getting the prices they want, and developers do not want to commit to unrealistic expectations based on fixed contracts. Fixed contracts are a big issue at the moment because, and this is why Porter Davis went down recently, because they're working on very slim 10% margins, and once inflation kicked in and construction costs went through the roof, their margins disappeared and they were trading insolvent. As you know, you can't trade insolvent in Australia. Sydney, for example, which is the biggest market, so in terms of February, now remember, we're always looking at data. It takes about a month to capture all the sales data because as agents sell properties, they fill out contracts of sale. You could be subject to finance, 14 days, 21 days. So when we sold something in February, the data doesn't really get captured until March. So we're always kind of looking back at data as investors and real estate agents, seeing what the market was doing back there. So if we're looking at right now in April, the best data that we have is February. I mean, March is not even complete right now. So in terms of Sydney, dwelling rose by 0.3%. So you can see there for the first time, Sydney has gone into positive territory where previously for the last 12 months it's been negative. This is why we're at that turn in the property market. For the quarter, it's still negative 2.4, and for the past year, 13.4% negative as well. But you can see that it's just turned the bottom. Okay, so we were at the peak, down, just to turn now, and it's going to go back up, and then go down, up and down, guys. But always going up in price. That's the key. Melbourne's the same. Melbourne has hit 0.4% in February. In March, it hit 0.6% positive. The data's not out yet, but it will be. So we're just behind Sydney about 2 months. Because Sydney goes on first, then Melbourne follows, and then Brisbane. So what's happened in Melbourne is for the quarter, negative 2.7, for 12 months, negative 9.6, but we've just turned the corner. Now, is that a good or bad situation? It doesn't mean anything. You've got to understand, it's just mathematical stats. You know, people think about these cycles like it's the most important thing to target. And the reason they do that is because they're uneducated. So if you have no education about a topic, and the media, which is the whole media, and most of the journalists have no idea how property works, otherwise they'll be multimillionaires and have massive portfolios like I have. Most of them are broken renting, so they have no idea what they're talking about. But the only thing they can really report is median price movement, which is the most useless way of measuring the market, right? It doesn't mean anything. It's just the dumbest way of measuring things. But people think, well, I don't know anything about this subject called real estate investing, so if everyone's focused on one area, maybe that's what I should be following. And that's why by default, people just keep talking about the median price moving. It's got nothing to do with it. Because the median price, guys, went negative 9.6, that means that there's 480 suburbs in Melbourne, right? 400 roughly established suburbs, and there's about 80, 90 new house and land estates. Does that mean that every property went negative 9.6%? No, some properties went up by 12, 15%, some went neutral, and some went negative 15. It's just, if you group all of them together, which I don't know why you would, and derive the median price out of all the thousands of sales, which is the middle property sold this year compared to last year, the difference is 9.6%. So this year could be a property sold in Essendon West, or let's say Nidri versus Dandenong North. So why do I care as an investor that the median price between Nidri today, which is a detached house, versus Dandenong North, the median price difference is 9.6%. What possible usage does that statistical data have to me as an investor? And it's nothing, guys. It's zero. All this stuff is irrelevant. This is what you got to understand to real investors. And the people that do watch these stats and are focused on this data, they're all broke, okay? They're all broke academics. I talk to developers that do 600 builds a year as individuals. Super wealthy. They don't follow any of this information. So if you have a bunch of really wealthy people, they don't know each other, but they do the same thing, and then you have this bunch of broke people, okay, that read the same information, don't you think there's a pattern that emerges there? Interesting, right? And by the way, I'm not telling you what to do. I'm just reporting what I see as an investor out there. Brisbane's the same. So you had a peak, went down. Melbourne, Sydney, and Brisbane are very synchronised as markets because it's based on interest rates, employment, etc., volume of stock on the market. And Adelaide, it's the same story. Perth, Hobart, and Darwin. And Canberra. Sales and listings. Sales volume continued to trend lower as buyers' demand slows. CoreLogic estimates that in the last 12 months to February, there were 486,620 sales nationally, nearly 500,000, down 21.2% compared to the previous year. Monthly sales volumes averaged 37,020 over the past 6 months, down from the average of 40,155 over the past 5 years. So what's happening in Australia as a phenomenon is people are holding on to houses for longer and longer because of the stamp duty costs, and they're not selling, and because they choose not to sell. And in fact, I'm going to do another YouTube video on talking about the perfect storm that has developed in Melbourne and show you suburbs where people, like in Vermont South, where people are holding on to properties for an average length of 22 years before they sell. And there's already areas in Vermont South, by the way, just a normal suburb, Eltham's another example, where people haven't sold for 30 or 40 years. And this will continue to be the trend. People will continue to buy in aspirational suburbs and hold those properties indefinitely and never sell until they die, literally. And a lot of times the kids take over and move into those houses. So the volume of stock in the best suburbs in Melbourne, which is either the Bayside, the eastern suburbs, or the top southeastern suburbs, which are the big aspirational houses. Like we're talking about Templestowe, we're talking about places like Park Orchards, Donvale, where you have 4,000 square metre blocks. A lot of those houses won't come back on the market for 20 or 30 years. So as your population swells and migrants are coming in with money, and we're attracting a lot of skilled migrants, and people holding on to large parcels of land and not willing to sell, what do you think that's going to do to some areas in terms of capital growth potential? Have a think about it. So yeah, so people are choosing not to sell because they can't get the price they want, and when they sell, they have to upgrade to something anyway because they've got to live somewhere, right? So there's nothing to upgrade to Well, why would you sell? You don't want to downgrade. No one downgrades, right? People upgrade as a trend. We buy better things, better and better, always. It's human nature. Median price on the market. So this is something that is a good indicator of the property pulse. Rather than median price fluctuations, what I like to look for is the amount of days it takes a house to sell on the market. So for example, in Melbourne, you can see there, the dark purple line is February 22 and the light purple line is February 23. So in Melbourne, in February 23, it takes 37 days to sell a house on average. Same time last year, it was 28 days, which was February 22 to the previous year. So you can see there, now obviously there's a number of other factors, you can unpack it further, but that tells you how, and look, there's different suburbs in Melbourne. There's house on land estates, apartments, and there's obviously suburbs like Ormond, Armidale, where there's 6 houses on the market. But it kind of gives you the pulse of what's happening in the city. To me, anything under 30 days is really an extreme market, because think about it. You list the property, the agent has a 90-day exclusive authority, you list it on realestate.com domain, which takes about a week to get the photos done, the write-up and everything else, right? And the marketing materials, about a week, give or take. And then suddenly it's sold within another 10 or 15 days. I mean, that is extreme. Normally, on the average market would be 45 days for an average house to sell. So to me, anything under 30 is extremely hot. 30 to 45 is a strong market, 45 plus is normal. And then if you're looking at 50 and 60 days, that's a slowish market. So that's kind of where we are at the moment. So because the volume is shrinking, even though we had a reduction we were in the property cycle in terms of demand and we're going back up, because the volume is lower, there's more pressure on properties now than ever before, especially with these migrants coming in. Now remember, when the migrants come in, a lot of them won't be able to buy property in the next 6 to 12 months. They'll have to get their jobs, pass the probationary period, get PR, and then suddenly they'll buy a house. A lot of them don't want to buy before they get to Australia because they don't understand how the market's structured and how the suburbs are structured. So a lot of them will actually secure their employment, rent initially, and then buy a house. Now what's happening in the rental market, it's a disaster. So a lot of them will have a great, I guess, urgency to buy a property than ever before, because rent money is dead money for a lot of migrants. Vendor discounting also talks about the vendor discount. So in Melbourne, for example, if you look at the dark purple line, once again, in terms of vendor discounting, so if you look at February 23 versus February 22, so we are discounting at 4.5, where previously to that was 4.1. Does that really mean anything? It doesn't really, because when you look at volume of stock at the same time, it can really misrepresent what the market's doing. But volume discounting happens, it's when the property gets passed at an auction, or if it's a private treaty, there's an offer made which was lower than the expectations of the vendor. 4.5 is an average market. It's not special, it's not depressed. I've seen 10% nearly vendor discounts, and I've seen close to 2 and 3%, which is a very hot market. In the 4 weeks to 5th of March 23, the volume of new listings totaled 38,479 nationally, while new listings have seen a seasonal lift. New listings are still 12.7% lower than the previous 5 years average. So we're slowly seeing people regaining some level of confidence in some markets and putting their houses on the market only in some suburbs. A lot of suburbs, people are still very negative. In fact, studies have shown some people are as negative in terms of consumer sentiment index as they were during the GFC in 2008. So they're very concerned about interest rates going up. The banking system is failing in America. You have builders and developers falling over in Australia. There's a lot of uncertainty for low and average income earners out there. Massive, and there's a lot of mortgage stress. And I'm going to do a whole video about mortgage stress and the volume of suburbs specifically where you have record high mortgage stress. Now that's a combination of reality of what's happening with families and also opportunity for you to maybe buy properties at a discount. So stay tuned for that video as well. Okay, and we talk about listings. At the national level, there were 144,985 listings observed over the 4 weeks to 5th of March 2023. The listings are still marked lower than the previous 5-year average. Now with listings, it's easy because we can grab the data very quickly. Listings are properties listed for sale. What's harder to capture with data is the properties that are actually sold, because properties can have a 60, 90-day settlement. You can have a longer settlement if you negotiate. This is why, these companies like RP Data, CoreLogic and Residex and all the other companies are always waiting for real estate agents to come back with sales data. But you can see that the listings are still lower overall in the national market because consumer sentiment is still negative, there's uncertainty, and also if you're selling a property, you might not be able to upgrade to something better, and we always upgrade. That's what human beings want to do. In terms of listings advertised, we're down relatively speaking for the same period of the last 5 years. So in terms of the whole national market, if you look at Australia as a whole, I don't know why you would look at that market as a whole, but anyway, maybe because we want to get a sense of the pulse of the market, it's down 15.4% in volume of listings for the average period of 5 years prior to that. So if you imagine you've got a market of 100 houses, you've only got 85 on the market at the moment. So there's a reduced amount of stock and volume, which puts more pressure on existing stock. But also, just so you know, in Melbourne, the best properties are just not there on realestate.com. So if you look at Toorak and Bryden, Hawthorn, the best mansions on the market at the moment, the ones that are there. And look, a lot of these wealthy people are not willing to discount them because they could have multiple properties. They're not actually mortgage stressed properties, so they will just sit there for years on the market if need be to have a buyer. But also, I'm looking at just normal investment stock in key areas like Albert Park, Middle Park, Port Melbourne, St Kilda West, Elwood, and there's just nothing available. I'm not excited about anything that's listed at the moment on realestate.com, guys. Like, ironically, we're at the bottom of the market and there's nothing good to buy. And that can happen quite often. You might be one of those people that's waiting for the market to correct itself. You get to the bottom, you can't borrow money because rates have gone up 10 times and there's nothing good to buy. So what did you wait all this time for? You've wasted all these years waiting and then you can't buy anything that's good. That's the reality of how the market works. It's a very ironic market. If you look at the actual auction clearance rates, we're hovering around 65.8% if you combine all the major capital cities. But once again, Melbourne and Sydney is always much higher than, for example, Brisbane. A lot of people in Brisbane don't go to auction, where Melbourne and Sydney, they do go to auction. So it's a healthy market. It's not an overheated market, but it's not a market that's dead. I've seen less than 50% during the GFC, and then I've seen 2003 97% auction clearance rate, which is just craziness out there. So it's kind of in the middle. It's kind of average, nothing special. Just an average market doing its thing. Now, the rental market is completely absurd at the moment, and this is the thing. I've never seen anything like it. And there's no solution for it, guys. No matter how much Labor can have discussions about solving the rental market, ultimately, if they touch negative gearing or disincentivise any private investor like myself from holding properties, I'll just dump my properties. They'll be sold to the private market. So they're going to be owner-occupier, which means all those properties that I have currently rented, they're going to be out of the rental market even further. And I'll just go overseas and buy some properties in America. So the thing is, if the government was smart, they'll create more incentives, like tax incentives, for investors to buy more investment properties to rent out to the rental market, not the opposite, punishing them and making it harder to own investment properties. But anyway, the rental crisis is real. If you turn on, especially Melbourne and Sydney, and now in Brisbane and the Sunshine Coast, it's spilled over. People are just living in tents, caravan parks. There's legitimate working families where you've got a couple, one's a police officer, one's a teacher, they're renting full-time, children are going to local school, suddenly that property gets sold, and it's going to be sold vacant, or it could be a deceased estate, or it could be a redevelopment potential. Now they're in the market, and they're competing with this whole market where there's 60, 70 applications per property. Cameron was telling me a month ago they had a townhouse in St Kilda on the rental market. Now, normally when they open up a townhouse in St Kilda, a 3-bedroom with a double lock-up garage, which is pretty rare in St Kilda, they might get 10 or 15 applications. They had over 100 applications in one townhouse. Can you imagine? And people were stapling checks of 3 months, 6 months in rental up front just to get in. It is that bad. We've never seen anything like it. So bad news for tenants, great news for landlords, obviously. So you can see there's just queues, for any property, and people are just stressed. It's an unfortunate situation, but it is what it is. So in terms of rents, I mean, I've never seen numbers like these, guys, since I've started investing in property 25 years ago. Rentals have gone up by 10.1% in Australia. So remember, inflation 6.8, 7.2. Rents have gone up by 10%, 7.5 in regional, and combined national cities, 11.1. Now in Melbourne, in the Bayside, rents have gone up by 25 to 30% for brand new properties. Because remember, with every suburb, you look at, for example, Aspendale, you've got old weatherboards that have an orange-yellow kitchen that smells like a dog, and then you got a brand new townhouse with marble splashbacks, right? So obviously there's going to be more demand for the marble splashback townhouse with smart technology and air conditioners compared to a moldy weatherboard house from the 60s that smells like a dog, right? Now, the number of applications is going to be different as well. So what people are doing is targeting new properties, which is the reason why I source brand new properties for investors. Those rents have gone up by 20, 30, even 40% in 12 months, which is unheard of in the whole, like I've never seen that happen before. And there's no end in sight. So we could have legitimately rental yields of 5-6% certainly in Melbourne in blue chip areas, which, as you know, normal blue chip areas have a rental yield of 3.5-4%. So in terms of serviceability, it's going to be an amazing thing for investors. So those investors that bought last year and the previous year, they've had those rental increases, they're virtually cash flow positive now, which means they can borrow more money and get into the market. The ones that have waited to get into the market, well, you can't get those rental increases right now. They've already happened already. So you'll be buying the property at a premium with a rental increase built in. So that's the reality of what's happening in the rental market, which is huge. So rental yields gone through the roof, which is great news for property investors, bad news for tenants. Dwelling approvals have come down. People are not buying houses. There's also been a collapse in the industry of different builders and developers. So you can see there, the number of new dwelling approvals fell 27.6% in the month of January, the lowest level since 2012. So uncertainty, high interest rates, builders, developers going under, people are buying established property over brand new properties and not building. Now that will change eventually. Finance is also down for new dwellings, but finance is record high for people refinancing. As you know, there's going to be a tsunami of 800,000 Australians that are coming out of fixed interest rates around August, and they're going to go from fixed to variable rates, which will be more than double what they were paying before. So mortgage stress is going to go through the roof in August. I'm going to do a YouTube video just on mortgage stress in August, September to see how that plays out. It doesn't really have any impact on the suburbs that I'm sourcing in, but it does have an impact on the market overall. First home buyers fell by 4.9% in January. First home buyer finance accounted for 22.8% of owner-occupied finance in the month, which is below the average decade of 23.7. So it's lower compared to 2022. So you can see there, first home buyer finance has declined by 28.5 through to January. So yeah, so there's a peak on first home buyers, now it's going down again because of other affordability issues, uncertainty what's happening in the market, and having no faith in builders and developers being in business 12 months from now. The RBA lifted the cash rate to 3.6% in March. So you can see that we've had an unprecedented amount of interest rates. These people that are buying properties here were just laughing all the way to the bank. Now it's 3.6. I mean, I've always said to people, you've got to factor in interest rates of 7% when you're building a property portfolio, because the average interest rate since 1950 has been around 7%. So yes, we're going to have another rate increase probably by the end of the year, and then maybe a cut towards the end of the year before Christmas, just to stimulate the economy and take the pressure off the market. But we'll see what happens. Remember, it's not so much the interest that's important for investors, it's the relationship between the interest rates and the rental that you're deriving from a property. If you've increased the rentals by 40% or 30% in 12 months, interest rate increases are relevant to you. But if you haven't done so, then you're in trouble. And remember, the ability to increase rentals in certain suburbs is determined by the house income per suburb, which I keep coming back to as the main fundamental reason why you invest in a suburb. So for example, in Melbourne, Melton South, which you should never invest in, the worst suburb to invest in for capital growth, has the lowest income per capita in Melbourne of any suburbs, about $450 per person per week. Richmond's about 2,800 per person per week. So obviously if you're buying a property, an investment property in Richmond, and I'm not talking about where to live, guys, I'm talking about purely as an investment vehicle, you've got a greater chance of increasing rentals in Richmond versus Melton South because of the different income that people are earning in each suburb. So the number one thing you got to look for is income demographics per capita per suburb as a determining factor whether you should be investing in the suburb. Go where the money is, because those people can live anywhere. Housing credit, so the same thing in terms of variable rates. Variable rates 5.28%, fixed rates 5.63%, and then fixed rate greater than 3 years 6.25%. I think rates will hit a peak and they'll come down very quickly. I'll talk about that in another video of what's going to happen in the market. Does it really impact much? No, it doesn't, because it doesn't make a difference. Interest rates don't occur in isolation. As I mentioned before, as an investor, it's all relatively speaking towards the relation between the interest that you're paying on the property and the rental yield. If you're paying 10% interest per year, but you're getting a 20% rental yield, do you care? The answer is no, you're 10% cash flow positive. So it's only relevant if you've got very bad rental income. That's important to you. But then the question is, why did you invest in that suburb in the first place? So it doesn't make a difference. You know, it's 6.8, 7.2, 5.9. What do these numbers really mean? It means nothing. It really means nothing. Where are we in the property cycle? You know, we have the peak of the market, decline, the bottom of the market, the growth of the market. Now, ironic, you know, people would love to buy here and refinance here, which is the main strategy that I'm trying to practice. But really, my success has been attributed to the first 10 years just buying whenever I can buy, because it's always challenging to buy. And, you know, it takes months to buy something. By the time you find it, then you have subject to finance 14 days, you've got a 90-day settlement. So you're talking 4 or 5 months just to do one transaction. So this thing about timing the market, guys, forget about it. Melbourne's just here, downturn, stabilising. How do we know that? This is the latest property clock from Harrington White Valuers. You can see that it's Melbourne there. Decline, soon it'll be here, and then it'll go through to the bottom of the market. Now remember, within Melbourne, there's 8 distinctive markets that all do different things. I mean, what is Melbourne? It's St Albans and Toorak. You know, is there such a thing as a Melbourne market? It's a bit of a bizarre concept when people ask you, what's Melbourne doing? It's like, if I can use the analogy of cars, it's like me going to someone, what are cars doing? Imagine I went to a car dealer and I said, what are cars doing? And then they look at, like, what are you talking about? What cars? Well, what are cars doing right now? Okay, are you talking about exotic cars? Like Ferraris, Lamborghinis, and Bentleys? Are you talking about Toyota Camrys? Are you talking about cars from the 60s? Are you talking about muscle cars? Are you talking about Japanese imports? Are you talking about four-wheel drives? Like, what are you talking about? Which segment of the cars are you talking about? Or what are cars doing? Well, I don't know what they're doing. It's such a dumb question. So when people ask me what Melbourne's doing, I automatically know they have no idea about investing, because there is no such thing as Melbourne. It's like asking a car dealer, what are cars doing? Which cars? Exotic cars? Are you talking about T-Fords? Are you talking about hot rods? Are you talking about, like, what are you talking about? If someone says, what a Nissan 300 ZX is doing right now, that's a value question. What's a Porsche 911 doing right now? Turbos from the 90s. That's a valid question. What are new Ferraris doing right now? What's a Nissan Patrol doing right now? Yeah, they're real questions, right? So what you got to do is educate yourself to a point where you're asking specific questions that can add value to your transaction, not just general questions. What's Melbourne doing? What's the car market doing? I don't know, it's going well. How do I answer that question? Imagine I'm a car dealer. People go, what are cars doing? They're going well. Yeah, cars are going well. You know, there's a shortage of cars, but overall it's good. Now, has that interaction added any value to you as an individual? You've wasted 30 seconds of your life, you've learnt nothing. How is that going to make you make a decision about anything? It's just a stupid interaction. You know, so, but remember, the difference between the rich and the poor is the rich have learned how to ask better value questions. So you got to target, you got to deconstruct the market, find the sections that are relevant to you, and ask questions that can add value to your decision-making model. So if you're in the market for a Nissan Patrol, you ask, what are brand new Nissan Patrols doing? If you're in the market for an S63 AMG, Then you ask, what are S63 AMG GTs doing right now? Are they expensive? Are they going down in value? Are they making new? I heard the combustion engine is becoming obsolete. They're going electric. Does that mean the other combustion engine models are going to go through the roof? That's a good value question. And that dealer will know, this guy knows what he's talking about. If you approach a dealer and say what a car's doing, well, then he'll look at you like, this guy doesn't know anything. Anyway, just thought I'd share that with you. So don't ask me what Melbourne's doing. There's no such thing as Melbourne. Melbourne doesn't exist. There's 8 markets in Melbourne. There's St Albans and Toorak. There's 600,000 and 12 million. And there is no correlation, unless the St Albans people want to do a home invasion in Toorak, between the two suburbs or the demographics of the people living there. By the way, if you're in St Albans, don't email me. I don't care. So within each market as well, not only do you have distinctive markets within Victoria, you have different markets. You have inner suburbs, metropolitan and regional towns, all doing different things at the same time. So, and they have different pressures and different considerations. During COVID-19, we saw regional towns boom temporarily. And I was telling people, not everyone wants to go to Bendigo and Ballarat, okay? People want to stay in Melbourne, okay? So there was a short-term boom that happened in a lot of coastal towns and tree change towns. It was short-lived and everything came back to normal very quickly. So whenever you look at the market, guys, what I look at psychologically, I always try to look for opportunities, especially when there's problems happening. When things are going well and the market's hot, you can't negotiate anything and you can't buy anything at a discount. So you're paying a premium for everything. So every time there's a market that's, let's call it negative or challenging, I try to find the opportunities within that market as an investor, because that's when you can get a bargain, that's when you can discount properties, lower deposit, longer settlement, access to the property prior to settlement, all those kind of wonderful things. So remember, 95% of people react. They get thrown around like a paper bag in the wind by the media. 5% respond. They make calculated, educated decisions based on prevailing circumstances and they act. And the differential is level of education. Level of education and financial literacy. Without education and financial literacy, there's just uncertainty and fear. You just have to get educated or you're going to be paralyzed with fear and uncertainty. That's what it is. There's no shortcut, there's no magic formula. Be fearful when others are greedy, be greedy when others are fearful. If anything, remember Warren Buffett, the most successful investor of all time, do the exact opposite of what everyone's doing. Because whatever the public is going left, you just go right and you win. Because the herd always gets that wrong. Always gets it wrong. Always gets it wrong. That's why everyone ends up dead broke at 65 in Australia. If the system worked, then 90% of people who retired would be millionaires. But the system is broken. The schools don't work, universities don't work, jobs don't work, mortgages don't work. That's why everyone tries dead broke at 65. Asset rich with 150,000 in a super, stressed for the rest of their lives. That's the reality of where we end up in the greatest country in the world, arguably. Dollar cost averaging, forget about timing the market, guys. Just invest whenever you can, and over a long period of time, you outperform the market compared to anyone else, even if you had to peak the bottom. Dollar cost averaging. Not a sexy strategy, it's been around for decades, but it works. Buy whenever you can buy, stick to the fundamentals, forget about timing the market. It's irrelevant. What suburbs represent the best value right now? And this is the thing about the suburbs. So these are the suburbs that I've been telling people to focus on for the last 2 years. And let me show you the growth. Black Rock, 30% growth. Mentone, 29.6. Frankston South, 29.4. Moriallic, 25.7. Albert Park, 24.1. Carrum, 19.8. Parkdale, 19.7. Balmoral, Frankston, Seaford, St Kilda, Sandringham, Aspendale. Now, I did a video on this 3 years ago in September talking about these suburbs, and during the COVID-19, I told people these suburbs would do double digits, and people were laughing at me saying it's impossible. How can any property or area go up in value? The whole economy is going to be shut down by Dan Andrews. There's going to be massive insolvencies. People won't be able to leave their house. How can these markets possibly even function? I was right, they were wrong. That's the reality. And you can watch my YouTube video from 2019, it's all there. And my predictions came through 100%. Couple of projects that I just want to mention to you guys that are worth looking at. If you want to go coastal towns, Mornington's a pretty cool suburb. This is an entry-level development that I've sourced, one of the cheapest projects that I've ever sourced, 695,000. There's only a couple left. Mornington's a great suburb. It did really well during the COVID-19 lockdown, but even beyond that, before that, it was always doing well. The whole area has had really good capital growth. So you can see that 12-month, 18.1%, 3 years, 47.8%, 5 years, 44% growth. I mean, 44% capital growth, it's ridiculous. This location is magic because it's just off Main Street. So it's very close to water, and it's actually off the main shopping strip, so you can walk down to a coffee shop and come back to your townhouse without driving. The entry level, 2-bedders, architectural design, great developer. We know this developer really well, so he's very hands-on, very proud of his work, and very detailed. You can see there's Mornington, there's the main drag, the project's around here. So it's just in the main shopping area of Mornington, which is where you want to be with a townhouse. And you're targeting a young professional couple, retired single person or couple with no children. So they're all identical pretty much. You have a single car garage, bedroom downstairs with a toilet, and then you have another bedroom upstairs with an ensuite, built-in robes, laundry, European laundry, and then you've got an open plan living and dining area in the balcony. 103 square meters, perfect entry-level, properties into the property market in Melbourne, renting for around 500, 550 per week, which would be very cool. For most of my clients, they're cash flow positive, great developer. A few have been sold since then, so there's only a couple of left. If you are interested, feel free to contact me, and I'll give you all the information on this particular project. Just so you know, if you look at the cash flow analysis, and obviously everyone's job income is different, but if you look at the rental income here, 580 rent per week, you're looking at cash flow positive scenario of $11 per week after all expenses. So this is with depreciation, fixtures and fittings, and building depreciation and negative gearing. So this is based on an average income from BMT. So they're cash flow neutral, cash flow positive. This is at 520 rental. And I think it will rent for around 550, given the current market and where we are. This is a really good development where we sourced in Port Melbourne. We had number 2 and 3, which both sold. Now number 5 is on the market. It's a 3-year-old property, looks brand new. So you have full depreciation on fixtures and fittings and depreciation on the building, less 3 years, obviously. Port Melbourne's a great location. This one's 1.425 million. This is at the back of the suburb, overlooking the heritage protected restricted houses. So great little 3-bedroom townhouse, targeting a young urban professional couple. Very good property. These lease very quickly, pretty much within a week of advertising. So you have multiple applicants, you've got to choose the right one. And once again, Port Melbourne, one of the top 10 suburbs in Melbourne for capital growth. Great beaches, you're 3 k's from the city. I mean, it's all there. I don't have to tell you how good Port Melbourne is. It's definitely one of the most iconic suburbs in Melbourne. Port Melbourne, Middle Park, Albert Park, St Kilda West are just prime areas for capital growth. These are, so you have 3 levels. On the ground floor, you have an entry, and you've got this kind of study nook or a foyer with a toilet, laundry. Then level 1, you have open plan living, kitchen island as well. So very much open plan, lots of light. Then you've got 2 bedrooms on level 2 with a ensuite, built-in robes. And then on level 3, you have the master bedroom with a massive ensuite with a balcony overlooking the city. Great views, great location. Capital growth in Port Melbourne, 12 months, 6.57, 3 years, 38.27, 5 years, 28.6. Your average will be around, 8 to 10% growth per year over 10 years. There'll be ups and downs, obviously. So these properties will double in value every 8 to 10 years comfortably. Once again, based on the previous one, they rent for around 900 to 950 a week. These are also cash flow positive by $9 per week after all expenses. And I'll do another video just on cash flow analysis on these properties in detail so I can unpack all the expenses and how it all works. So once again, if you're interested, feel free to contact me at any time. Now, what's the next step? I hope you enjoyed the video and the update. Ultimately, you're going to put yourself into one of these four categories. You're going to be either, number one, the analytical compulsive information gatherer, which a lot of the engineering people that are listening to this are those people. They have Excel spreadsheets. They do analysis to paralysis, and they continue to pay 100 grand a year in tax. God knows why. I keep telling them to buy property, but they just refuse to buy property. And I don't really care. It doesn't impact what I'm doing. But I just keep telling them, okay, you're making 250, you're giving 100 to the government. Would you like some of that 100 back in your pocket? No, Konrad, we don't. We love giving 100 grand back to the government. We want to analyze the market for the next 10 years. That's cool. There's also the get-rich-quick gambler, which I'm scared of. These people just want to jump into something and make money instantly. And this is, I'll tell you now, the property market is not for these people. You're going to be very disappointed. You're better off doing cryptocurrency or Amazon dropshipping or something else, because property is a long-term 10-year plan. You might not make any money in the first 12 months at all. There's no guarantees you're going to make any money in the first 12 months. There's the comfort zone investor, where they invest within 3 or 4 k's of where they live. They usually have 2 or 3 properties, and they literally live. So, for example, let's say you live in Hyatt, you buy a property in Hyatt and Mentone, and then you drive around, and every week you check on your own property. Okay? Interesting people. I would really encourage them to leave the comfort zone, get educated, and look at other suburbs that give you higher capital growth potential where you live. But hey, at least they're in the game. Congratulations. And there's the active, savvy, educated property investor. These are the guys that take time to get educated. They create a team of experts around them. And these are the clients that I work with long term and help them to accumulate great properties and build a great property portfolio. So if you're interested in learning more, definitely we are running the live events again in our office here in St Kilda. Just jump onto realestatefasttrack.com.au. We only have 55 seats. They book out really quickly. I think the next one is in a couple of weeks, and it's virtually sold out now. So just check the dates. The website's always up to date. These is 2 days of education with myself, Cameron Fisher, and Stephen McClutchy from Loans Australia. It's very detailed, it's very current, and it's how to structure, build, and automate a large property portfolio from scratch. Day 1 is pretty much classroom environment. Day 2, we sometimes do a bus trip, or we do a virtual bus trip, depending on access to sites. Sites access has been very restrictive recently with COVID-19 restrictions. So we've done virtual bus tours through video and things like that. But we are trying to get the bus tours back again, because we love doing them. They're really cool. We take you out, look, show you suburbs, and show you real properties. Once again, check the dates on the website, realestatefasttrack.com.au. And I hope you attend one of the events, and I hope to meet you in person one day. If you can't make, tickets are only $47, by the way, and you get a hard copy of my book, which is Real Estate Investing Made Simple, which is kind of like a manual for the whole course as well. So you get to keep that. Now, for those of you who want to go to the next level and really get educated, what I encourage you guys to do is to buy a copy of, and you can access this instantly, of the online video course called the Property Portfolio Accelerator Summit 2022. What I did last year was I got together the whole team that looks after our clients, the most successful clients that are buying, 8, 9, 10 properties just through our company. And this is the whole team, and I had to really twist some arms for them. These guys have never done public speaking before. I got them into the in a hotel, 4 days of content, and we put it together into an online video course. So we're talking about, obviously, accountants, financial planners, lawyers, depreciation experts, building inspectors, property managers, everyone involved in the whole transaction. And remember, the best money you're ever going to spend is in your personal development. The highest dividends you're going to be ever earning is on your personal development. And the difference between you today and 12 months from now is the books that you read and the people that you interact with, especially consultants like this. So we've turned it into a 30-hour online video course that you can kind of absorb over a period of time. That includes a 600-page manual of all the PowerPoint slides. It's pretty full on. It's very detailed. But the good thing about it is you can learn it at your own leisure and your own pace. So if you're a novice investor, you can just watch half an hour to an hour a night. If you're a seasoned investor, you can probably smash out 4 or 5 hours at a time and get with it. I've heard people who have watched it in 1 week very comfortably. and the feedback's been amazing. So if you want to get a copy of that yourself, it's $997. Simply go to propertyriches.com.au/PPAS 2022 and get a copy of the online video course. It will change your life. It's an amazing piece of education. Look, it's everything that I've learned over the last 25 years condensed into one convenient online video course. So once again, and also stay tuned for future dates. We will be running another one live probably next year. We aim to run these events every 2 or 3 years because they are full-on events. 4 days, a lot of time, a lot of preparation to run these events. For those of you interested in working with my company and myself, all I do is source properties for clients. You're welcome to book in a strategy session with me where we turn an idea and a plan into action. And basically what I do is I find out where you are currently, where you want to be, and I do a plan around property acquisition. Remember guys, if you fail to plan, you plan to fail. That's the most important thing. If you don't make changes, nothing will change. So sometimes just interacting with someone like myself who's been doing this for a quarter of a century now, 25 years, I'm 46. I started investing when I was 18, and in the same market, I mean, I know the Melbourne property market like the back of my hand. I mean, my whole background is banking and financial planning. So I've been in this industry since I started, basically out of uni. And I'm passionate about property. Property is my hobby, my obsession, as I call it, my healthy obsession. Someone spending an hour with me could make a difference between you taking action and building a large property portfolio and doing nothing and wondering what could have been in the next 10 years. What I do is I make things simple. A lot of people do this. To go from A to B, they waste so much time and energy going around in circles in the wrong direction. What I do is develop a plan that will take you from A to B and create a path of least resistance based on my experience. So it's an hour strategy, it's free, there's no catch, there's nothing that you need to sign or buy. I'm just going to share with you what's possible based on your income, assets and liabilities, and how you can build a large property portfolio using blue chip property through buy and hold. You also get an introduction to my whole team, my mortgage broker, my accountant, my financial planner, everyone. I'll give you my whole team that I use personally, and you get priority access to my properties that I source. So you can be on the waiting list as well for specific suburbs that are coming up, like St Kilda's coming up, for example. I've got 9 townhouses there that I've sourced. They're pretty much all sold because I've got a waiting list for St Kilda. So you want to get on those lists as soon as possible. We develop a strategy and it's paint by the numbers. It is literally like step by step what you need to do to get your first property, second property, third property. Now, to qualify, there's a minimum income and equity requirement because obviously the cheapest properties that I'm sourcing right now in Melbourne are $695,000. There's a couple of projects that I've just sourced which were $650, but that's really rare. Most projects are $695. So you need to have at least the ability to borrow and buy a $700,000 property. So as a single person, you need to be on $95,000 per year and have about $112,000 in cash or $126,000 in accessible equity. It doesn't need to be your equity, it could be your parents' equity. But on 95 grand, you can borrow roughly $700,000 based on today's interest rates. If you're a couple, you need to be on about 140 combined with the same access to equity, 112,000 in cash or 126,000 in accessible equity. If you qualify the criteria, feel free to email me directly and we can set up a time. If you've been to a live event, all you got to do is return this form back to us and we can organise a time. My email address is conrad@investorsprime.com.au. That's it, guys. It's been great spending this time with you. I hope you got value out of today's video. This is Konrad Bobilak, and I'll see you on the inside.